Now let's take a look at example number 21. An entity acquires an asset on the first day of the reporting period for 120 with a useful life of 6 years. Alright, so basically the cost is 120 and useful life is 6 years and there is no residual value. It depreciates the asset on SLM basis. If it is depreciating the asset on an SLM basis, it means that depreciation each year, depreciation per annum will be 120 divided by 6, which is equal to rupees 20 per annum. The depreciation will actually be 20 per annum. There is no residual value, so it's directly 120 divided by 6. The tax rate is 30 percentage. The tax rate is 30 percentage. What the question is also saying is the tax depreciation is as assumed in the computation below. They've given a tax computation over here. What they're actually saying is you have a 120 asset at the beginning of year one. They have actually given a depreciation charge in each year. All right, generally it's on a WDV basis, or in tax you have a higher depreciation in earlier years followed by a lower depreciation at a later point. So those are the numbers that they've actually given over here. So we are actually having a 90 rupees depreciation in the first year followed by 10, 7, 5, 5 and 3. Whereas in accounting, if you notice, in accounting the cumulative depreciation is actually increasing each year. You have 20 and it's increasing by 20 every year in such a way that it actually goes down to 0 at the end of year 6. All right, so now let us actually calculate DTA and DTL in this particular example. So again, we're going to have the same format, which is basically we have year 1, year 2, year 3, year 4, and this time we have additional year, year 6 also, because the asset is having a useful life of 6 years. All right. So we start with the carrying amount of the asset. The carrying amount of the asset, remember the cost was 120. The cost is actually equal to 120 and we are charging a depreciation of 20 rupees every year. So at the end of year 1, the carrying amount will be 100. At the end of year 2, it will come down to 80, followed by 60, 40, 20 and then 0. All right, so every year it's going to reduce by 20 rupees. The cost was basically the asset was acquired at 120 at the beginning of year 1. So at the end of year 1, it's going to be we're going to have a carrying amount of 100 because we would have charged a depreciation of 20 rupees for the first year, and same way we're going to have an equal amount of 20 rupees depreciation for the next subsequent years, and finally the asset is going down to 0 at the end of year 6. Then we have got the tax base. All right, we've got the tax base. If you notice, they've actually given us the depreciation charge in each year. All right, so the first year depreciation is 90. So therefore, 120 minus 90, the tax base would be basically 30. Sorry, it is going to be 30 because in my tax balance sheet, I will be showing the asset at 30 rupees. All right, I purchased it at 120. Depreciation of 90 is allowed as a deduction. So I will basically have a value of 30 rupees in my tax balance sheet against this asset. Now in the second year, the tax depreciation is 10 rupees. All right. So basically it'll come down from 30 to 20. All right. I'm going to have a depreciation of 10 rupees in the second year. So it's going to come down to 20 rupees at the end of year 2. The tax balance sheet will have this asset at 20 rupees at the end of year 2. The third year, it's 7 rupees. So from 20, I further deduct 7. I'm going to have a tax base of 13. For year 4 and year 5, the amount is going to be 5. The tax depreciation is 5. So 13 will come down to 8 at the end of year 4 and it will come down to 3 at the end of year 5. Now in year 6, we have a depreciation of 3 as per tax and therefore it's actually coming down to 0 as at the end of year 6. All right, the tax base is asset is going to be fully depreciated in the year 6 by charging a depreciation of 3 and therefore my tax base is coming down to 0. Now let me calculate the temporary difference each year. All right, I'm plotting the temporary difference for every year. It's 70 in year 1, 60 in year 2, 60 less 30, 13 is 47 in year 3, 40 less 8 is 32 in year 4, 17 in year 5, and in year 6 it's going to be equal to 0. All right, so I have a temporary difference of 70, 60, 47, 32, and 17. Now, the nature of this in all the years, it's actually going to be taxable only because if you notice in every year, the carrying amount is greater than tax base, which means that every year I'm determining that in future I'm going to have a taxable profit, I'm going to have a net taxable profit, and therefore I am actually having plotting this down as taxable temporary difference each year. Now, if you look at it, although I didn't really mention it earlier, at the end of year one, I'm assuming that 70 is my net taxable profit that I'm expecting in future years. At the end of year one, I'm anticipating a net taxable profit of 70 at the end of year one. Now that is actually reducing to 60. If you think of it, why is it reducing to 60? Because 10 rupees is probably realized in year two. As at 70, I was forecasting that I will have a future taxable profit of 70. Of that 70, 10 rupees is actually realized in year two, and therefore at the end of year two, I'm saying that my future taxable profit will only be 60. At the end of year one, I forecasted a profit of 70. Out of that 70, 10 rupees has been realized in year two. Therefore, as at the end of year two, my forecast is I will only have 60 taxable profit. Same way, 13 would have been realized in year 3. 13 rupees is probably already realized in year 3, and therefore I am having a net forecast of 47 for the next years. I'm going to have a next net forecast of 47 taxable profit at the end of year 3 for the remaining future years, and therefore you're actually saying that this temporary difference is actually reducing each year over here. All right, but the nature is continuing to be taxable temporary difference. Next, because it's a taxable temporary difference, I'm going to have a deferred tax liability. All right, the question gave a tax rate of 30 percentage. Because it's a taxable temporary difference every year I will have a deferred tax liability. The first year, the deferred tax liability will be 70 multiplied by 30 percentage, which is equal to 21. All right, I'm actually, because this is a liability, I'm plotting this in negative. All right, because it's a liability, I'm plotting this in negative. From now onwards, if it's a deferred tax asset, I will plot it as positive. If it's a deferred tax liability, I will plot it as a negative number. All right, so deferred tax liability is of 21. In the first year, I'm going to have a change in DTL also of the same value. All right, I'm going to have a negative 21, negative representing a deferred tax expense. All right, so I have a deferred tax liability of 21. The change in deferred tax liability for year one is going to be the same, which is negative 21, and this represents the expense for the year. Negative over here represents expense. Remember, what I mentioned is this row represents the balance sheet row. All right, this row represents the balance sheet row, which means at the end of each year in the balance sheet, I will be disclosing this value, and this amount represents the amount that I'm going to disclose in P&L. This is the amount that I'm going to disclose in P&L. In year two, I have a taxable temporary difference of 60. Therefore, I will have a deferred tax liability of 18. I'm going to have a deferred tax liability of 18 because it's a liability. I've again plotted it as a negative number. But over here, if you notice, my liability is actually reduced from year one to year two. My liability has reduced from year one to year two, and it has reduced by 3. And a reduction in liability is a positive amount. A reduction in liability is actually a benefit that is coming. All right, because when a liability reduces, you recognize a benefit. All right, so the journal entry for this 3 rupees will be deferred tax liability debit. I need to reverse my deferred tax, so I will actually record a deferred tax liability debit of 3 rupees and credit deferred tax expense of 3. All right, over here my liability is actually reduced, and therefore I am going to have a deferred tax income in the P&L account. All right, so the journal entry will be deferred tax liability debit, deferred tax liability debit to deferred tax expense or to deferred tax benefit. That is going to be the journal for this year. Next, moving on, next year, 47 multiplied by 30 percentage. 47 multiplied by 30 percentage would probably be 13.1. If I'm not wrong, it's going to be 13.1, or it's actually going to be 14.1, sorry. So my deferred tax liability is going to be 14.1. So here it is actually reduced by 3.9. It has reduced, my liability has reduced by 3.9. Reduction in liability is the same journal entry as what we have for year 2, but the amount is going to be 3.9. Next year, 32 multiplied by 30 percentage is going to be 9.6. It's going to be 9.6, which means that my liability has actually now reduced by 4.5. The change in liability is actually 4.5 over here, which means again in year 4 also I will be recording a deferred tax liability debit of 4.5, credit deferred tax benefit of 4.5. Moving on to the next year, 17 multiplied by 30 percentage is going to be equal to 5.1. All right, so my deferred tax liability is now reduced again by 4.5. It's reduced again by 4.5, which is 9.6 minus 5.1. And therefore, in the fifth year also, my journal entry is going to be the same. And finally, in the last year, I'm going to actually have a zero deferred tax asset or a liability, which means my liability should entirely be reversed. My liability should entirely be reversed. I have a liability in my books of accounts of 5.1. I need to bring it down to zero. So therefore, in year 6, I will have a deferred tax liability reversal of 5.1, and the journal entry will actually be the same, which is DTL debit to deferred tax benefit of 5.1. All right. So therefore, in this case, what happened is we recorded a deferred tax liability in year 1. It got reversed in stages. All right. It got reversed in stages. A portion of it got reversed in year 2, year 3, year 4, year 5, and year 6. All right, so it's gotten reversed in stages. Another point that I would like to actually mention is the sum total of all this. The sum total of all this will definitely be equal to zero. All right, the sum total of this will actually be equal to zero because deferred tax expense is created in one year and is reversed in another year. If you remember the interest receivable example we had, we created a deferred tax expense of 30 in year 1 and we reversed it in year 2. So here also the sum total of the deferred tax expense and deferred tax reversals over multiple years will actually be equal to zero. We are creating a deferred tax expense of 21 in the first year, and that's actually going to get reversed in the subsequent years. All right, the sum total of all the reversals will also be equal to 21. With that, we are actually done with example number 21.